Hello, everyone. Thank you for making the choice to invest in yourself and your practice by joining today's CE accredited financial planning session. Learn how to confidently discuss corporate planning opportunities with your clients. I think I might be moving a little bit slowly on screen here just because we've got a ton of people joining. So I'm just going to wait a moment here before we get started to make sure nobody misses anything. Okay, perfect. So again, welcome. Thank you for being here today. My name is Alex Mercer, and I am going to be your host. I'm joined by my colleague, Steve Arnott, Snap's financial planning project lead, who will provide today's demonstration and run the Q&A. You must stay for the full session today in order to be eligible for your CE credit. Shortly after the session, you will receive a brief form to fill out via email, which is how you will request your certificate from today. Before we get started, let's just do a quick tech check to make sure you can all hear me and see my screen. Can I get some of you to send me a quick yes or even a smiley face through your question tab? Just click the arrow beside the word questions and a window will pop up where you can type and hit send. That's exactly how you're going to send any questions you have throughout the session. Oh, wonderful. Thank you so much, James, Tina, Jason, Yibin, Joe. Glad to know you can all hear me and see us. So Steve and I have our cameras turned on just to say hello. We will now shut them off to give you a full screen view of our presentation today. So for those of you here today who aren't already familiar with Snap Projections, Snap is a Canadian financial planning software platform and part of the CI family. We help great financial advisors grow their practices and receive more referrals through effective financial planning. If you're wondering what other advisors have to say after using Snap or how we compare to other solutions, you don't need to look any further than the reviews page on our website. Thousands of Canadian advisors are already using Snap Projections to provide financial planning for their clients and grow their practices. If you're wondering about Snap, asking your colleagues who are already using it is a great place to start. You'll also notice you can now hop over to Capterra, which is an independent third-party software review site. We are very pleased to be sitting at 4.9 out of 5 stars and extremely thankful to our users who have taken the time out of their busy schedules to leave us an online review. On Capterra, you will find advisors saying things like none of their clients retire without a Snap projection, and that the software has become foundational to their firm. Now, you may have already heard that a French version of Snap's financial planning software is finally coming to fruition, and we are so excited about this upcoming launch. I'm going to drop the link to this page in the chat now. So if you click the arrow beside the word chat in your control panel, you can pop that up and you can click over to this page. So if you would like to be formally notified when Snap Projections becomes fully available in French, please add yourself to the wait list here. For now, we continue to provide the client reports in French, and we also have French language resources, such as the financial planning questionnaire and sample reports. But it won't be long until the dashboard as well as customer support is fully available in French. Now, today, as you are all aware, we are going to see one of our newest functionalities in action when we get into the case study and begin discussing capital gains. Everyone has been talking about the proposed changes to the inclusion rates in the federal budget, and that's going to be a highlight of today's session. However, less than 2 weeks ago, we had a very exciting launch of the highly anticipated Snapshot. This is the new one-page summary report. It's a highly customizable summary output of the comprehensive full financial plan. Now, you have the option for a summarized report, a full report, or a combination of both. Many advisors are using the snapshot as a standalone client deliverable or as an executive summary to the comprehensive full financial report. Steve will be showing you this new functionality closer to the end of the case study when we're reviewing the report from the plan that we're going to build. This new snapshot summary report is quite literally going to transform the way you can deliver advice. The snapshot is highly personalized, yet still created with ease and efficiency. Each one of these can be different, as you'll see when we get there. So today's session has been fully inspired by your requests, so a big thank you to everyone who took the time to provide your feedback and suggestions after our last session in March. Corporate planning received the most votes by a landslide, so the focus today will be on how you, as the advisor, can provide your incorporated clients with more value. So whether you're currently providing corporate planning or would like to get started, we have a few different goals for you today. So if you're not currently offering corporate planning, our goals for you today are to learn language and discussion points around corporate planning, to gain more confidence to have those high-level discussions with your clients, to learn how corporate planning can be layered onto personal planning in practice, and finally, to see how advisors are presenting these types of plans to their clients in a way they can understand. Now, for those of you who are already providing corporate planning, our goals for you today are to uncover new corporate planning ideas and opportunities to explore with your clients. We want you to learn what corporate functionalities exist in Snap and how to best leverage them. We want you to learn how to model the impact of corporately owned life insurance. And you're also going to see how we can model the proposed capital gains inclusion rate changes. So with that, I would like you to be introduced to today's case study client, Olivia Garcia. Olivia celebrated her 50th birthday in January and is hoping to retire in just 10 years. Olivia is a small business owner paying herself a salary from active business income and accumulating retained earnings within a holding company. How can we combine corporate distributions with personal resources to ensure her spending goals in retirement are achievable? How could corporately held life insurance be leveraged? And what other items should we consider for an optimal outcome? But most importantly, how can we share this information with Olivia in a way that makes sense to her? Now, you may be wondering how it's possible to model and explain such complex planning scenarios with efficiency and ease. And that's because Snap is a financial planning software that was designed with advisors for advisors. We believe there are 4 core elements that are absolute essentials for any good financial planning software. Number 1 is transparency. When you need to explain something to your clients, you need to first be able to understand it yourself. I talk with advisors all the time who tell me that if they cannot see how the numbers are being calculated, they feel uncomfortable presenting the plan to their clients. Next comes flexibility, customization, and control. Without that, you can't model your clients' lives accurately or make the plans truly personal. Good financial planning software should also be easy to learn and easy to use. Lack of ease of use is one of the biggest barriers to software adoption. If it's hard to use or the learning curve is steep, no one wants it. Last, but certainly not least, comes customer support and service. If you're not using Snap, I'd encourage you to ask your colleagues what their experience working with our team has been like, and I'd also encourage you to compare these response times with your current provider. So what you're about to see here as I hand this over to Steve is that Snap will show you where the numbers are coming from. You'll see how much flexibility and control you have within the software and how straightforward learning to use the program will be. To run a simple projection and answer some basic questions, we just need to enter a few data points. Name, date of birth, province of residence, income, current asset holdings, and any planned contributions. That's it. This is one of the key elements that sets Snap apart from other financial planning software. Many advisors use it live during prospect meetings to quickly create simple plans that prove the value of working together within 5 to 10 minutes. You can provide value before asking for the business. Today, you'll see the simple plan set up, but then we will be layering on a bit more complexity. So I'll get Steve to take over now and log into Snap.
Terrific. Thanks so much, Alex. And thank you everyone for joining us today. Snap Projections is a web-based platform, which means that you can access your account from any Chrome browser on any computer without the need for a download. You'll go to snapprojections.com, and then in the top right corner, you'll click Login to enter your username, password, and you'll have the option to enable a multi-factor authentication for added security. I've done that during today's session, so I'll click Login and go directly into the software. I'm taken initially to my clients page where I can access any of the projections I've created previously, or I can get started on a new plan by clicking Add New Client. We'll start off entering in Olivia's personal information. She was born 1974 and currently lives in British Columbia. In the top left corner of the software, you'll see that there are 3 main sections to the tool. The first is the scenario setup, which we'll proceed through shortly, and that's related to entering in things like our general plan settings, the client's expense goals, their incomes, assets, debts, and so forth. Once we're done entering in all of our base client data, we'll then proceed to the planning pages, where all of that information will come together to show us our client's life on one page. From here, we can review key information for the projection, we can customize values for any given year or any period of the plan, and then once we're comfortable with all of the numbers, we'll then proceed to the client report in order to create a customized client-facing PDF with all of our desired charts, tables, and commentary. For now, we'll continue on with the scenario setup. I'll click Next, and we'll go to the General Settings page. We're going to begin the projection as of 2024 with a target retirement age of 60 and a projection length until age 100. At the top of the page, you'll see that we have the option to import the most recent FP Canada guideline assumptions for inflation and returns. So if I click on that, it's now brought in the most current 2024 values. If we scroll down, we have inflation at 2.1, and we have the gross rate of return values for cash, fixed income, and equity. And these can all be reduced by expected management fees to arrive at our expected net return assumption. So I'll use 1, 2, and 5% on a net of fee basis. I'll click Next and go to Expenses, and we have quite a bit of flexibility for entering in expenses in Snap to really tailor it to yours and your client's needs. The first input is related to the client's annual target spending in retirement. So we're going to enter in $80,000 of net after-tax spending, and this will be adjusted for inflation each year of the projection. We can also add additional expenses such as an extra travel budget for a portion of retirement. So we have $10,000 of annual travel indexed for inflation starting at age 60, running until 74. And we'll highlight that in the chart so that we can draw attention to that goal being funded. So we have 80,000 annual plus 10,000 additional for this specific 15-year period. I'll click Next and go to the Incomes page. And this is typically where I would enter in income for my client if they were receiving it from an employer. In this case, because Olivia is self-employed and she has a corporation, we'll remove this income line from the plan, and we're going to enter that as a distribution from her corporation once we've added that to the projection. We could, if we wanted, add other income such as rental income, or we could add defined benefit pension plans from a previous employer, for instance. But in this case, those don't apply to Olivia, so I'll click Next and go to the Assets page. A default non-registered account with a $0 balance is added to each plan to give the software somewhere to allocate future surpluses. In this case, because Olivia already has a non-registered investment account, I'm going to remove the default and just enter in her personal information. So she has a non-reg with $50,000, and that has a current cost of $40,000 and an investment allocation of 30% fixed income and 70% equity. And you'll see Snap has pre-populated the rate of return assumptions for each asset from our general settings page. And then it's calculated a total portfolio rate of return based off of the allocation that we've indicated here. Any of the individual rates can be customized on an account by account basis. So if you expect a higher rate of return for equity in the non-reg, you could adjust this percentage and that would impact the portfolio return assumption. I'll also add in a TFSA of 110,000, similarly invested as 30/70, and an RSP of 325,000. Now that we're done entering in her personal investment accounts, you'll see over top of the table of accounts, there are tabs for the different registered account types. If I click on TFSA, you'll see that I can customize additional settings related to that registered account type in the software. And this is a very common theme throughout Snap. What you can do is you can create quick and simple projections that use all of the default conservative assumptions that Snap pre-fills the software with, or you can come into the individual settings and customize them to your client's unique circumstances as desired. So I'm going to leave the TFSA contribution room just for 2024. I'll go to the RRSP tab and I'm going to enter in her current contribution room of $32,000. You'll see I have the ability to add additional pension adjustment if they had a defined benefit pension plan, base the minimum off of a younger spouse, and then convert the account to a RIF in any year of the plan. Going back to the client's assets, I'll scroll down to the real assets section where I can input her home, which has a current value of $800,000 and a cost base of $450,000. The appreciation rate defaults to the inflation value, and you can customize that as desired. You can also add in a future purchase age if the client's saving up for their first home, or if they're going to downsize or buy a rental property in the future. And you can also model this future sale of a property, again, if they're going to sell and buy a new home, or if they're going to sell and then rent or move into long-term care later in the projection. And we can indicate whether any of the real estate transactions will be subject to capital gains tax. I'll click next and we'll go to the debts page where I can input her remaining mortgage. So she has a mortgage with $125,000 at 5% interest and $1,800 monthly payments. Under the real asset column, I'm going to link that to the home so that if we sell the home at any time in the plan, if there's still a mortgage remaining, the software would pay that off for us automatically. Clicking next, we'll go to the government benefits page where we can customize the expected CPP and OAS values. So we can change the start age that we want to begin CPP payments. And we can either enter in a dollar value if they're already receiving the benefit or if they have a Service Canada statement, or we can enter in a percentage of maximum based off of their employment history. So in this case, we're going to start at 65 with an expected benefit of 75% of the maximum. For old age security, we'll start at 65 with an expectation of 100%. On the left, you'll see that we do have a few more pages available for inputs. We could add insurance policies to the plan. We could conduct life needs analysis to see if more life insurance might be recommended. We can add RESPs, and we can customize additional settings similar to the registered account settings that we saw earlier. We can refine plans as needed to really tailor the tax and other calculations to our client's case. And then the last input option is for corporations, which we'll be adding as Olivia is a small business owner. So she has a company called Evolve Design, currently based in British Columbia. It's eligible for both the federal and provincial small business deduction. And as we scroll down, you'll see that we have the ability to add other notional account balances to the corporation. So if the client has RDTOH balances or capital dividend account balances, we can input those here. You can obtain that either from the client or their accountant. If you don't have this information available, you can always leave the values as 0, and that's going to create a more conservative starting point because they won't have access to these additional tax advantaged notional account balances. So leaving it as 0 will create a more conservative assumption within the plan. If you do know some of the values, you could input them here. So for instance, Olivia currently has 15,000 of RDTOH and 20,000 of capital dividend account balance. As we scroll down, we have the ability to enter in the ownership structure and set up the disposition assumptions related to the tax calculation when the corporation is wound up, either in the estate or in any selected year of the plan. And as a final note related to the notional account balances, these are only related to the starting year of the projection. SNAP will calculate and track all of these going forward for you automatically. So this would just be the starting values, and then SNAP will take it from there forward in the projection. We'll go to the assets page for the corporation and we'll enter in the investments, which is currently $500,000 with a cost base of $400,000, 30% fixed income, and 70% equity. Again, we could add other financial assets to the corporation. We could add real assets such as a building or equipment. We can add debts and insurance, which we'll do shortly. And then we can customize settings as needed later on in the plan. For now, I'm going to proceed to the planning page of the corporation. And the planning pages can be overwhelming the first time that you see them, but they're one of the most powerful and valuable sections of the software once you know what you're looking at. So I'll click on planning pages, and it's going to give us all of the information related to the corporation all at one time and allow us to customize any values that we see in blue or purple for any 1 year or any period of the plan. On the left, we have the year and Olivia's age. And then we have the option to enter in active income and expenses related to the operating business. Then on the right, we can see settings and calculations related to the holding company, the passive investment income for the business. So in SNAP, you can enter both the operating business and holding company as one single entity. And that's going to have a huge advantage for you because everything will flow back and forth automatically. So any retained earnings will get deposited to the holding company. Any impact on the small business deduction is going to be automatically calculated based off of the passive investment income from the holding company. And any income earned above the small business deduction is automatically going to add GRIP for the holding company. So it'll all be integrated and they'll communicate back and forth to make sure that your notional account balances are accurate going forward. In this case, we're going to input $450,000 of current active income, and she expects that to continue until she retires, and we're going to index that at the rate of inflation. So we've added in operating income. When we make that change, you'll see in the top right corner, the Run Corporation button has turned red. And this means that we've made a change to the planning page that has not yet been recalculated and factored into all of the other numbers. So rather than constantly refreshing this page and moving the numbers on you, we wait for you to finish making any changes, at which point you can click the red Run Corporation, and that's going to recalculate the whole page. I'm going to make a few additional changes. So we're going to enter in salary of 200,000, again, copying down to age 59, indexing for inflation, and enter in tax deductible expenses of 50,000 down to 59, indexed for inflation. And now that I'm done making changes, I'll click Run Corporation, and we'll see all those numbers updated. So now we have net operating income of 200,000, and that's being taxed at the small business deduction rate. We have taxable investment income of 12,763 from our existing portfolio. That's being taxed at the full passive rate. We can see the total tax here, which is being subtracted from the 200,000 of retained earnings and deposited into the investment account. And we can see those contributions continuing down until retirement. at which point she's projected to have built up about 2.9 million in the corporation that we could then use for retirement spending purposes. So now that we're done setting up the pre-retirement period for the corporation, we'll do the same for Olivia by clicking on her name and going to her personal planning page. So once again, we have access to all of the information related to Olivia from now until the end of our projection. On the left, we can see the year and our client's age. We have the calculated discretionary cash flow. So this is the remaining cash flow that Olivia has based off receiving 200,000 of salary, paying 5,100 in personal CPP and EI, 60,000 in tax, and then 21,000 in mortgage payments. So that leaves her with 112,000 left over for either personal savings or spending. We also have a lot of other great data on this page, such as the marginal and effective tax rates, the client's corporate value and distributions, the personal account balances and the rates of return. We can also input any contribution or withdrawal, which we'll do shortly. And then we have the home value appreciating, the mortgage being repaid, and information about her net worth and estate. The last thing I'll do is enter in some contributions to her personal accounts. So she's contributing 32,000 per year into her RSP. I'll copy that down until age 59. And she's also contributing the maximum into her TFSA. And in this case, I'm going to enter in 10,000, which I know is higher than the annual limit is expected to be for the foreseeable future. And when I run scenario, Snap is going to check my contribution request against its guardrails. So it has calculated the actual expected annual and it's changed my contribution to that maximum value. So there's guardrails in place in Snap to help prevent you from over contributing to a registered account or from paying out dividends that wouldn't be possible given the corporation's notional account balances. So now that I've entered in RRSP and TFSA contributions, I can come back to the base expenses, which is the discretionary cash flow left over, and we can see that's been adjusted for those additional contributions. So now there's 88,000 left for personal spending needs outside of the projection. We continue that down until age 60, at which point our target spending of 80,000 a year has taken effect. It's been indexed for inflation to 98,000 as of that first year of retirement. We have our additional travel budget. And as we scroll to the right, we can see that Snap is automatically taking money out of the personal financial assets in order to reach the client's target spending goal. And it does that all the way until age 71, at which point it's depleted the personal assets because we haven't yet indicated how we want to use those corporate funds that we built up previously. So now that we have a good sense of the plan and what we might need to do on the corporate side, we can go back to Evolve Design's planning page, and we'll go over to the dividend columns for Olivia. So in any year of the plan, we can enter in a non-eligible, eligible, or capital dividend, and that will allow us to pay that as a personal distribution, and that would add the money to Olivia's cash flow, just like we saw with the salary. In order to help with distributions, we have the balances table, which shows the expected capital dividend account, GRIP, and RDTOH balances related to all of the investment income and active income coming into the corporation. So we can see those building up over time. As a very simplistic starting point, I'm just going to go to the first year of retirement and enter in 70,000 as a non-eligible dividend, copying that down to the end of the plan and indexing that for inflation. Once I run the corporation, I can see that Snap has now increased the total withdrawals out of the investments. And as I scroll down, I can see that the balance of the account is remaining fairly in line at about 3.5 million. If I go back to Olivia's personal planning page, now that I've added in the dividends, I can see the dividend income here under the corporation section of her planning page. And I can see that Snap has adjusted the amount that it's taking out of her personal accounts to only top up the cash flow needed between her dividend income and her target spending. So now we're taking out less from the personal accounts And as a result, those are expected to last all the way until the end of the plan without any shortfalls. So in this case, we've been able to show Olivia that based off of our projected accumulation in the corporation, she would have the ability to meet her $80,000 a year indexed after-tax spending goal, plus a bit extra for her travel, plus have a large buffer personally and a more significant buffer in the form of her home and her corporation. So we can also review this plan in the form of charts. So if I click charts in the top right corner, I can see the cash outflow. So this is showing where her money is going each year of the plan. The majority of it is going towards her spending needs. So that's that 80,000 roughly per year indexed for inflation. We can see the additional travel, her taxes payable, her mortgage, and then contributions to her investments. On the inflow side, we have the employment income for the first 10 years. Then we have significant non-eligible dividend income coming out of the corporation, and she's topping that up with CPP and OAS. And then we have RSP, TFSA, and non-reg withdrawals. And in terms of her overall net worth, we can see how that's broken out and grows over time throughout the projection. And all of these charts are fully interactable, so I can select and deselect any section in order to customize the view. So this would be her liquid personal financial assets. So now that we're done with the first scenario, I'm going to go up and adjust the title. So we'll just call this scenario 1 base case. And I'm going to do one final review to look for any opportunities for us to enhance or optimize this plan for Olivia's goals. So as we review the projection, we can see things like the marginal tax rate here, where prior to retirement, she's at about 40% a year. Then when she retires, her taxable income drops a bit. Her marginal rate is at 28%. And then once she depletes her personal non-reg and TFSA, she's then using entirely taxable dividends and taxable RIF, and that's spiking up her marginal tax rate and causing quite a bit of OAS clawback to occur in the plan. So we can make a few adjustments to our corporate drawdown strategy and see whether we can optimize this plan to better achieve Olivia's goals. So I'll copy this scenario, and we'll call this scenario 2. And then we'll just add retirement drawdown optimization as the title. So now that we have this second scenario, we can go to the Evolve Design dividend payment and tweak these a bit in order to take advantage of her lower taxable income prior to starting government benefits, and then shift some of her later taxable dividends into more tax efficient sources such as eligible or capital dividends. So I'm going to increase her dividend at retirement to 150,000, indexing that down until age 64. So now we can see we have higher dividend distributions initially. We'll revert back to that 77,000 value until age 72, at which point she's going to be forced to start taking her RIF. So we want to reduce her taxable non-eligible dividends. And then in that same year, we're going to start paying out some capital dividends to get her tax-free money. So now I'll run the corporation. We can scroll down on the capital dividend and we'll see that that 40,000 continues until the point at which SNAP has calculated that the built up room would have run out. So here it's reducing that value down to the expected amount generated each year of the plan. If we go back to Olivia's personal planning page, we can now see that her marginal rate is a bit higher for that first 5-year period while she's pulling out more money. But then from age 65 onwards, the rate drops to 28,000 all the way to the bottom of the plan. And we can see that there's very minimal OAS clawback as a result of those changes. So while this looks better, we can also more quantitatively decide whether it's better for her. So we can go to the estate before tax column, go to the final year of the plan, And then we can compare the two scenarios. So in our original scenario, as of the end of the projection, she was expected to have 6.1 million after tax available for her beneficiaries. Another way of thinking about this is just the after tax buffer in the plan, whether she wants to spend more or leave it for her estate. This is the amount that we're working with. And after our optimizations, we've improved that to 6.4 million. So we've added about 300,000 in total value through our changes to the distribution strategy. Now, both the dividend payment and the tax optimization are things that are on our roadmap for future automation. So we want to help you as much as possible to make those changes to the plan as quick and intuitive as possible. For the time being, you can create different scenarios and try different strategies to see what's most optimal. And then we'll continue to work on automating and improving that workflow to help save you time. So now that we have our optimized scenario, the next question that Olivia has is related to the recently proposed increase to the capital gains inclusion rate. So I'm going to copy this scenario, and then we're going to model a plan that applies those higher tax assumptions to see what the impact would be on her overall projection. So as a default, right now, SNAP continues to use the current inclusion rate of 50% until this actually receives royal assent. We won't make any changes to the base software logic, but we have added a tool. If you go to Scenario Setup, Settings, and then Income Taxes, you can scroll to the bottom to the experimental section where you can apply the proposed capital gain rules starting never by default or as of 2024 or 2025. If you apply 2024, it assumes that all capital gains in the plan are going to occur after June 25th of this year and will be subject to the higher inclusion rate. If you want to model two scenarios, one where they're liquidating some of their portfolio prior to that cutoff, then you could apply the changes as of 2025, which will give you the ability in SNAP to model transactions still occurring at the lower inclusion rate and then having all future values taxed at that higher rate. And that will allow you to compare for one scenario to another, what if any amount is the best way for them to liquidate any unrealized portfolio gains at the moment. So in this case, I'm going to click 2024 because we just want to show what the impact of those higher inclusion rates will be on her projection. So if I go to Evolve Design, there's a couple ways that I can see the impact on the plan immediately. The first is in the taxable investment income. This capital gain column is now reflecting the 66% inclusion rate rather than the previous 50%. And if we go down to the capital dividends being paid, we can see that it's running out earlier, and then these annual amounts are also reduced because it's now only receiving 1/3 instead of 1/2 of the capital gains as new room to the capital dividend account. So with those changes reflected, if we now go to the final year of the projection, we can see what the impact is of those higher inclusion rates on the overall plan. So with the 50% inclusion rate, she had 6.4 million projected. With 2/3 inclusion rate, we have 5.9 million. So it's about a $500,000 impact on the overall estate. So certainly is an impact, but has still left her able to achieve all of the goals that she's identified. So now that we've been able to show her the impact of the higher inclusion rate, the final thing that she might have a question about is whether there are alternative strategies that she could use that might be more tax efficient in that world of higher inclusion rates. So we'll copy this scenario and we'll do an illustration using corporate insurance. So I'll change the title, scenario 4. And what I'll do is I'll go to Evolve Design. I'll go to Scenario Setup, down to Insurance. I'll enter in the corporate policy. And I'll do that by clicking Edit under the death benefit. And I have this customizable table that opens. And I can actually paste values directly from Excel or another table from your insurance quote provider directly into the software in order to save time and ensure accuracy. So I've just hit Control V, pasted all of those values into their respective columns. And now I have the death benefit, the cash surrender value, the cost base, and the premium. And Snap will take care of all the calculations from here in terms of deducting the premium from cash flow and calculating the capital dividend account related to the death benefit less the cost base. So if I now go to the planning page, we can see the insurance policy has been added. We have the premium, which is reducing the total contributions into the financial asset. That's then reducing the total balance that builds up by the time that they retire. And then if we scroll all the way to the bottom, rather than having 3.3 million, they now have 2.4, but they also have an expected death benefit of 1.8. So with all of that factored in, we can go back to Olivia's planning page, go to estate before tax, go to the final year, and then compare that use of corporate insurance to the previous scenario. So we've added about 900,000 in value based off of this year of the projection. Now, there's a few factors at play here. One, Olivia had a large cash balance in the corporation that she did not need for her spending goals. The second factor is the rate of return assumption that we have on her investment portfolio and the types of investment breakdown in terms of tax. So there's a lot of factors that in this case have suggested the insurance premium would be advantageous. It may not apply to all client cases, but this is how you can illustrate the pros and cons of different investment strategies and different products within your client's strategy. So those are the 4 scenarios that we wanted to run today. And the final thing that we'll be presenting is the new snapshot feature within the client report. So we've gone through scenario setup, we customized the plan on the planning page, and now that we have our plan that we want to recommend to Olivia, we're going to go to client report to select what pages and customize any of the language in order to then present that information to her. So from the client report, we can go to the report builder where we can customize what pages we want to include and in what order. So we have the cover page, we have a disclosure, we have our snapshot functionality, we have individual pages with lots of different information that may or may not apply to each client case. So if I scroll down, if I don't want the estate details, for instance, I could click on that and hit delete, or I could drag out the recommendation details and that's going to remove it from the plan. And any pages that I don't already have included, I can find in the gallery section and I can drag those back in any location that I want. So once I've selected the pages to include, I can then go to the report editor and I can customize any language. So for instance, if I click on the goal summary of the snapshot, you'll see that it's pre-populated with a combination of static text and dynamic variables. So this name field is a dynamic variable that you can input into this page so that every new projection that you create, that variable is populated for that specific client. You can also add static text so that any new scenario that you create is reflected there, or you can add static text that would just reflect for this specific client scenario. So it's completely customizable and you can save your templates for future plans so that you can quickly generate your ideal client deliverable. We do have lots of videos and articles related to taking full advantage of the client report. So you can see those once you've signed up or once you access the help site. There are other integrations between the report and the software. So if I go back to planning pages, for instance, and I use the recommendation tool, Snap can tell me what the maximum spending would be in order to avoid shortfalls in the plan. So in this case, she could spend $86,561 in order to deplete her personal financial assets. Now, when I go back to the client report and click on the goal status, that information is pre-populated into the report. So everything that we've done on the planning page is being dynamically pulled into the report in order to provide accurate and current information. And once I'm done customizing values, so for instance, if I wanted, I could add an extra bullet here. So Her two options for her overfunded status are either spend more or leave more for your beneficiaries, whichever you prefer. We could also add other text to things like the recommendation summary. Here it's a customizable text box, so I've added in some notes. And next, if I go to report preview, I can see how all of this comes together as a client deliverable. So we have our cover page with our branded logo, our selected background. We have our disclosure, note to reader, and then we have that snapshot. So all of that dynamic and customizable information has been brought into a single page so that we can have digestible and actionable conversations with our clients about their plan. So you can either do this as an executive summary, as I have here at the start of a projection. So we could start off with a high-level overview and then continue on into the more granular details. Or we could go back to Report Builder and just generate a report with these snapshots. So if I go snapshots only, I can go to Report Preview, and now I just have those 2 pages. I can click Generate PDF, and then I would download that and share that with my team or with my client directly. So those are the main areas of the software that we wanted to present today. We have had to move fairly quickly just to show all of the capabilities. We have a dedicated customer success team that you can call or email with any questions. We can also do one-on-one screen sharing to make sure that you're fully comfortable in the software. If you click Help and then Help Center, once you sign up for your trial, you have immediate access to our team. You can give us a call, send us an email, or you can also find answers to some of your key questions. If you want to enter in an inheritance, you can type in that key term, find out more here. You can also learn more about snapshots by reading the article or watching our quick summary videos. So hope that that's been helpful. I'm going to now pass it back over to Alex so that she can walk us through a few next steps and then open it up for the Q&A.
Wow, Steve, thank you so much. That was incredible to see you do so much in such a short period of time. So as Steve just said, we know we have covered a lot in this hour, but let's think about what we accomplished for Olivia. Numbers aside, what is she walking away with after this meeting? How is she feeling? She now knows that her retirement dreams are going to be her reality. Her goals are achievable. Everything has been explained to her in a way she can genuinely understand, and she now has an action plan and the peace of mind she was seeking. For Olivia, this has been a great experience, and at the end of the day, that was the real goal here. So with that, just a few items before we move into the Q&A. I've had a ton of questions come throughout the hour, so thank you so much, and we are going to answer as many of them live as possible. So a reminder to existing Snap users that you can be earning free months of Snap when you send referrals our way. We have recently revamped our referral program to be even more valuable. Referred advisors will now get 50% off their first month of Snap. If the referred advisor stays with us beyond their 14-day free trial and 30-day money-back guarantee, you will receive a 1-month credit to your account. That's an entire free month of Snap projections. If you are on annual billing, you will receive a $100 credit against your next renewal. There's no limit on how many times you can do this. We have created a new referrals page that you can access from within your Snap account to make it even easier to leverage this program. And anyone who signs up for a free trial today and becomes a paying user of Snap, this program will apply to you in the very near future. Now, if you think Snap might be a good fit for your practice, I'd encourage you to start a 14-day free trial today while everything you have learned is still fresh and can be applied to your own client cases. I have already dropped the link to the page you're seeing now in the chat, so you can click on that to open up this page and have this on your device before the session closes out. There's no risk to starting a free trial. We will remind you 2 to 3 days before billing is set to start to ensure you have ample time to cancel if you do not want to stay on. If you cancel before your trial ends, you will not be billed. There are no contracts. You can cancel anytime. So there's no risk to getting set up with a free trial today. On our pricing page, you'll see there are 2 plans for you to choose from as an independent advisor. The advisor business plan is the one you want for the corporate module, which you have seen today. You'll also notice that stress testing is an add-on, but it is free during your free trial, so make sure you enable it right away. If anyone wants to see how the random and historical data sets can be applied to stress test your projections, let me know and we will try to cover that in our last section of the day here. So with that, let's move on to the Q&A. So just give me a second here, Steve, to look through the questions. A ton of questions asking about the replay. Yes, this has been recorded and it will be emailed out to all of you in about an hour. And it's also going to be available on our YouTube channel probably by tomorrow. So you'll have full access to this recording. So first question, Steve, can you show us the life needs analysis tool for life insurance?
Yeah, absolutely. So if we go to scenario setup and then down to insurance, there's a calculator for life needs analysis. We can click edit inputs in order to start our calculation. So we could describe this as estate goals or specific beneficiaries if they're planning to support a particular person. Now, typically we would do this for maybe a spouse of a family or someone who has a particular estate goal, and then that goal is going to factor into the remainder of the input. So in this case, if Olivia was married or providing ongoing support to another individual, they might have an analysis horizon of 10 years. So they want to be able to provide a specific amount of income to that individual for a 10-year period. And they might assume that the insurance proceeds that they receive would earn 3% as part of that future income need. If the survivor has some income, so maybe it's a spouse earning 80,000, you would enter that here. If it's a beneficiary earning no money and you want to provide maybe $80,000 per year of support, you would enter all of that information here. So whether they're earning anything and then how much total that person needs for their ongoing cash flow. So that's related to income replacement. Then continuing on, we can cover things like debt, we can cover tax on the estate, we can include any of their existing resources. So if the client has existing life insurance, we would be able to deduct that from their total calculated insurance need. If they want to include their non-registered or TFSA. Now in this case, because she's a single individual, we could include 100% of her financial assets towards being able to provide for that insurance need. So once we're done with all of our settings, we would then proceed to done, and we get this nice client-friendly summary of the calculations. So in order to provide that income replacement that we entered of $80,000 a year for 10 years, they need about $769,000. To pay off their mortgage, they need $125,000. To pay their taxes, they need $500,000. So their total insurance need is $1.4 million. And they have existing resources of about $485,000, which results in a new life insurance need of $900,000. Again, this was quick estimates based off of a particularly made up case. If your client had a more standard insurance need, then you'd go through that calculation and be able to come up with this summary chart of their insurance need broken out by category.
Perfect, Steve. Thank you. So a few different types of questions around one-off expenses. So in addition to our, our base monthly annual expenses, can you show us how we would model if a client wants to plan you know, a $50,000 vacation, or perhaps invest in a new business, periodic new car purchase, etc.
Yeah, so right now we have this additional travel budget that's starting as of retirement for the 15-year period. If we go back to scenario setup and then expenses, we could add other one-off expenses like a new car. Maybe they want to spend 60,000 per purchase. They assume that that will increase with inflation over time, and maybe they expect that they'll need their next car as of age 55. They'll purchase their last car no later than age 85, and they'll do that every 7 years. So we can select the frequency, and then we can highlight this in the chart so that, again, we know that we're covering that funding. We could also do other expenses such as a gift to sibling or to a child. So we could do a lump sum, say 100,000, maybe in the first year of retirement, so at age 60, and just for 1 year. So we'll put 60 in both the from and to age. And we can select whether we want that value to be indexed forward for inflation or not. So in this case, we just want a clean, even 100,000, regardless of what that will be on a real basis in the future. We're just going to plan for that for the time being. So we can enter in our various one-off or recurring expenses on this page. And then when we go back to the planning page, we can see those itemized on the planning page. So we have the additional travel, we have our new car purchase occasionally throughout the plan, and then we have our gift to our sibling. Now, if the cash flow management is turned on, which defaults to the age of retirement in your scenario, you'll see that Snap is automatically pulling that money out of the client's investments. So it's adding that cash flow need to the annual calculated total, and then it's pulling the money for you automatically. If the expense is occurring prior to the cash flow management turning on, then Snap will not automatically take that money because it'll just show the available discretionary cash flow in that year. So it's been reduced because of the added expense. And if we want to fund that, then we can just copy that and add it as a withdrawal to our non-registered account as an example. So maybe we want to fund the whole amount. Maybe some of that will come out of their other spending needs for the year, but we have the option to enter in withdrawals from accounts in order to fund expenses that have been identified prior to the cash flow management. And this is a major, one of the most important pieces of functionality in Snap. You can turn on the cash flow management in any year of the plan, and that just gives you so much flexibility in terms of whether you want to assume that all cash flow will get spent, or whether you want to assume that up to a certain amount will be spent and then anything over that is going to be saved. So you have the flexibility to do it automatically or manually as you need.
Awesome, Steve. Thank you so much. So looking at the clock here, we are nearing our end time, and I want to ensure I leave a moment for you all to answer the exit survey. We'd really appreciate it if you could take a moment to let us know what you would like to see next time. As I mentioned at the beginning, this content was completely driven by all of the requests from last session. So we are listening. If your question wasn't answered live, I will follow up with you via email. I see there's still a ton there, so I do apologize. Thank you so much for being here with us today, and I hope this has been a valuable session for all of you. Again, I'd encourage everybody to get set up with a free trial of Snap to get in there and give this a try for yourself. Enjoy the rest of your day, and I'm looking forward to continuing the conversation offline. Bye for now.